Morgan Stanley says a summer of pain is coming as a bear market isn't over. I'm your host, Steven Van Metre, and thanks for joining me today. And while many investors are eagerly buying every dip, hoping for a bear market rally, Morgan Stanley's analysts say, watch out below. Let's over to Morgan Stanley, where we picked this story up from their weekly warm-up that a recession is not fully priced in. With our view for lower multiples and earnings now more consensus, the markets are more fairly priced. However, it does not price in the risk of recession in our view, which is 15 to 20% lower, or roughly 3,000 on the S&P 500. The bear market will not be over until a recession arrives or the risk of one is extinguished. And that's really the key here to the story is everybody thinks that if stock prices just fall a certain amount, that the bear market's over. Morgan Stanley's telling you not a chance that this is happening until something else comes along and changes the narrative. What do forward earning per share contractions look like in the absence of a recession and during a recession? Well, forward EPS contractions over 2% are fairly rare, according to Morgan Stanley's experts. During non-recessionary times, the median EPS contraction is about 5%, but during recessions, those contractions ramp up to 14%. And such a decline would take the consensus of $239 down to $206, putting a 14 to 15 multiple on this implies a price range on the S&P 500 of somewhere between $2,900 and $3,100. And where can equities trade in the event of a recession and was already priced? Well, according to Morgan Stanley, the price action suggests that equities have already drawn down 60% of the recessionary average, as 2022's price action is relatively similar to recent recessions in terms of leadership, albeit less severe in terms of magnitude. And that's one of the big stories going on right now, that you're hearing people say that the bear market's almost over because, well, we're pretty close to what an average drawdown is. But that's assuming that this was an average bull market, and it wasn't. It was one born on fiscal and monetary stimulus. And with fiscal stimulus gone and the Fed rapidly reversing monetary stimulus, we might have a very unusual bear market, one for the record books. And so what does Morgan Stanley, or where does Morgan Stanley think the S&P is headed? Well, it's currently right here around between 3,700 and 3,800. We know Bank of America has called for 3,400. Well, now they're down to 3,000 here, with Morgan Stanley taking the lead on the low side of these projections. Keep in mind, this is the pre-pandemic peak around 3,400. And at 3,000, that would take stocks well below their pre-pandemic peak. And is a recession already priced in? Well, no, according to Morgan Stanley's experts. Coming into the year, we've had a very out of consensus view that valuations would fall more than 20% due to rising rates and tighter financial conditions. Furthermore, we also believed earnings were at least likely at risk given payback in demand, rising costs, and inventory. And we're going to see more about the story of rising costs and inventory, particularly going forward, the fact that inventory is rising and the costs are going to come down as that inventory doesn't move. And we start to see that in the purchasing managers' indexes. We got some preliminary data last night and this morning. Let's take a look at what Morgan Stanley thinks of that. What they're saying is lower purchasing managers' indices imply a higher equity risk premium. So what that's saying is when the blue line goes down, which is the PMIs, that the earnings risk premium is going to go down. And what they're trying to tell you is as people buy the dip thinking stock prices are going to go up, what they're suggesting is no, the opposite is going to happen, and people are paying a big equity risk premium on that bet. Now let's go on, because we've got some data from the Eurozone and the UK, and then later in today's show, the US data, as Eurozone economy slows sharply on a squeeze from record prices as a composite PMI falls to a 16-month low as living costs surge and pent-up demand for services after a pandemic are fading. An indicator for economic activity by S&P Global fell to a 16-month low in June, driven by rampant inflation, concerns over energy, and rising borrowing costs. All things are also going to affect the U.S. And while the overall gauge still signals modest expansion, manufacturing output declined for the first time in 2 years. And here we can see those preliminary PMIs. And again, these are just a flash of what is potentially to come. And a number over 50 means it's an expansion. The higher the number, the greater the expansion. Below 50 is a contraction. 50 is unchanged. And look at here, we see that if we went from 54.6 down to 52, how about the services 56.1 to 52.8, telling you that the expansion is slowing down. So that rate of change, that growth is coming to a really slow point. And usually when that happens, it means it's about to flip and reverse and go the other direction. How about over to the UK, coming out of the Eurozone now? Businesses brace for deepening recession as PMIs are steady for May, but point to a contraction in the coming months. Bad news for the equity market as well, as the economy is running on empty with inflation surging. S&P Global said its Purchasing Manager Index held at 53.1 in June, while a gauge for new order volumes fell at the sharpest pace since the pandemic recovery started in March of 2021. Companies reported rising pay pressures and increasing concerns about fuel and energy bills. And here we can see, looking at the UK, we see that the manufacturing PMI slowed from 54.6 to 53.4. And how about the services? The preliminary data unchanged, saying there is a definite slowdown. And these are big assumptions as we now come back to the Morgan Stanley piece. At this point, a recession is no longer just a tail risk given the Fed's predicament with inflation. Indeed, this is the essence of our fire and ice narrative, the Fed having to tighten into a slowdown, or worse, with their bear case for second half or first half of 2023 always assumed a recession outcome, but the odds were 20%. Now they're closer to 35% according to their economists, and I'll tell you what, I think that's much higher than that, actually. Of course, experts generally underestimate, but I think we're going to likely see a second quarter recession, and if not, we're really on track for a third quarter one, as you'll soon see. But one thing they note is, of course, the 10-year Treasury will not be static either, with most investors believing it's headed much higher. Well, Morgan Stanley says it would likely fall considerably if growth expectations plunge, and that's something we learned from our friend Jeff Snyder, of course, says that it's not just about inflation expectations, and that's what everyone believes, that yields are a function just of inflation, also a function of growth expectations. Growth comes down, then inflation comes down, and yields, well, they go down with it. The bottom line for equity markets are very oversold, but they can stay oversold until market participants feel like the risk of recession has been extinguished or at least reduced considerably. And what they're saying is, while retail investors are cramming in, the big players are saying this market isn't for them just yet. And we don't see that outcome in the near term. How we can't rule it out either, and understand markets can be quite fickle in the short term on both the downside and the upside. What we can say with more certainty today versus a few months ago is that earning estimates are too high in the event a recession is avoided. We think our 3,400 to 3,500 near-term downside target accounts for that kind of earnings risk we envision in the event of a soft landing. But for us, the end game remains the same. We see pretty poor risk reward over the next 3 to 6 months, meaning the summer of pain is coming with recession risk rising in the face of stubborn inflation readings. And valuations are closer to fair at this point, but hardly a bargain if earnings are likely to come down and or recession is coming. And they recognize a lot of pain has already been inflicted on investors. But one thing that shouldn't be in more pain, and that is if the market does go down to 3,000, you shouldn't see that happening in your portfolio. If you're concerned about that, I'll put a link up here to Portfolio Shield and description below. Strategy's got a unique hedging mechanism that's about to go gangbusters. Let's continue on, because I see a third quarter recession. Well, that seems to be a lock. The only question is, will we start to see one in the second quarter? And will the Fed respond? Well, doesn't look like it. As Fed Chair Jerome Powell says, higher interest rates could cause a recession. It's essential we bring inflation down. As Fed Chair Jerome Powell said, the central bank's battle against inflation could lead it to raise interest rates high enough to cause a recession, off their most explicit warning this year. It's not our intended outcome at all, but certainly a possibility, he said during his congressional hearings yesterday. We're not trying to provoke, and we do not think we need to provoke a recession, but we do think it's absolutely essential to bring down inflation, which is running at a 40-year high. And we're looking for compelling evidence that inflation is coming down, and we don't have that. There are lots of stories out there about how this should happen, and some people think it's very clear it will. Until we do see it happen, we need to keep moving, indicating that there's absolutely going to be a rate hike next month and potentially a follow-through in September. But will inflation come down? Well, good news, pal. It is. Check this out, because the stock market leads inflation. So you see growth coming down here in red. And as growth comes down, inflation comes down. We've got the Wilshire 5000 on a year-over-year rate change against, in blue, the consumer price index on a year-over-year rate change. Notice here we go back to the great financial crisis. Stock prices leading inflation down. That and then comes back to Morgan Stanley's call that rates are headed down. Absolutely. They've got it right. Let's continue on, because you know what's worse than high inflation and low employment? Well, it's high inflation and a recession with millions of people out of work, according to Senator Elizabeth Warren. And I hope you'll reconsider that before you drive this economy off a cliff, as she pointed out to Fed Chair Powell. Well, good news, Senator Warren. You don't have to worry about that, because when we get high employment, we're going to get low inflation. Let me show you. Here we have the weekly unemployment claims data, now down only 2,000 from last week, but we're still starting, the beginning of an upward trend. We see 229,000 initial claims. We know the 4-week moving average is still kind of bottoming out and turning to rise. The key, though, the total claims up 14,500 to 1.296 million, suggesting, again, we are not far off from a rise in unemployment claims. And how do we know that? Because when we take this same consumer price index data on a year-over-year rate change, and we put on the 4-week moving average of initial claims and adjust it at a log scale so we can see it as inflation starts to come, or as unemployment claims start to rise in red, notice inflation comes down. So you see unemployment claims rise, inflation comes down, unemployment claims rise, inflation comes down. So, Senator Warren, nothing to worry about. There won't be high inflation with millions of people unemployed. And why is that? Because Congress is not giving people out big money on unemployment anymore. And that's the key, is that people have less money when they lose their job, because unemployment benefits are less than their former pay, can't spend as much, and that means consumer prices are headed lower. And now we look to the U.S. data to see that things are slowing down much quicker than perhaps most realize. As the U.S. PMI has plunged to a 2-year low amid, quote, remarkable drop in demand, according to Zero Hedge. And here we see the flash, or the preliminary manufacturing PMI, going from 57 down to 52.4, and that's nearly stall speed, with 50 being unchanged. How about the services sector that many said was going to continue to rise and rally? Well, went from 53.4 just again down to stall speed of 51.6, not a good sign. As commented on the data from the chief business economist at S&P Global, he said, the quote, the pace of U.S. economic growth has slowed sharply in June, with deteriorating forward-looking indicators setting the scene for an economic contraction in the third quarter. So here we have already the early signs that we already know there's a first quarter contraction. Now the data is suggesting there's going to be a third quarter contraction. We don't know if second quarter will, but it's going to look likely, putting us squarely into a big recession in the third quarter, as the Fed is still tightening. Bad news. And this has consequently been a remarkable drop in demand for goods and services during June compared to prior months. Keep this in your pocket for future data that's coming out. And businesses become much more concerned about the outlook as a result of the rising cost of living and drop in demand. A corollary of the drop in demand was less pressure on prices, with the survey's inflation gauges for firms' costs and their selling prices falling sharply in June to suggest that although still elevated, price pressures have peaked. That also validates that interest rates are coming down. So now you know why Morgan Stanley is calling for a summer of pain and a big drop in the markets. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.